Hello, good day. The objective of this video is to discuss the basic features of common stocks. This video is the first part of topic 2, Introductory Finance. After you have understood the key characteristics of common stock, we shall proceed to common stock valuation. Some of the key questions we are going to ask in this video include: what is common stock? Who are shareholders? What are the rationale, risks, and concerns in common stock investment? What is a primary market, secondary market, stock exchange and dealer market? Stay tuned. We shall learn together. What is equity? Equity capital is a source of external financing used by firms. It is obtained from investors who then become part owners of the firm. Equity can also be defined as the value attributable to the owners of a business. A common stockholder, also known as a shareholder, is a person, company, or organization that owns at least one share of a company's common stock. Shareholders are essentially the true owners of a company. As such, they have certain rights and privileges. Shareholders reap the benefits of a business success. These rewards come in the form of increased share price or profits distributed as dividends. Conversely, when a company loses money, the share price may drop and no dividend is paid, which can cause shareholders to lose money. Common stockholders are sometimes referred to as residual owners. Why is that so? Because they receive what is left, the residual, after all other claims of the firm's income and assets have been satisfied. Buying shares means taking on an ownership stake in a company. As part owners, common stockholders receive the right to vote on certain business decisions and corporate leadership. Historically, the stock market has delivered high returns to investors over time, depending on the firm's earnings. Instead, common stocks have registered one of the highest historical returns among the various asset classes over the long term. Stockholders are remunerated via price increases and dividend payments. Stocks are easily diversified. Shareholders can invest in a number of stocks in different countries, sectors, and industries, which give various growth opportunities and risk reduction. Investors can also select the stocks based on their investment style and objectives. Stocks are highly liquid. Most stocks trading on a major exchange can be bought and sold easily. This liquidity gives investors the flexibility to convert their stock into cash quickly if needed. Common stock investment is subject to higher risk. Stock prices are linked to the issuing company's earnings. When a company is experiencing financial difficulties, the price of the stock can decline. Companies are not required to pay dividends to their common stockholders. Shareholders are the last in line behind other creditors in bankruptcy proceedings. Preferred stockholders and bondholders or creditors get paid first. If a company goes bankrupt, stockholders are paid last. The stock markets can be volatile with frequent price swings. Share prices are subject to long-term cycles in the market. In short term, stock prices can be volatile, rise or fall sharply because of an overreaction to good or bad news. There are two basic forms of returns to shareholders. First, dividend. And second, capital gain. What is dividend? A dividend is a distribution of profits by a corporation to its shareholders. Dividend can be defined as a share of profits. When a company earns a profit, the profit can either be reinvested in the business or paid out to shareholders as a dividend. What is capital gain? Capital gain is an increase in an asset's value. Capital gains is due to the change in price. If investors can buy low and sell high, they can make a profit from the stock investment. However, if the share price drops, investors will suffer a loss. Common stockholders have certain rights pertaining to their equity investment, and among the most important of these is the right to vote on certain corporate matters. Typically, common shares carry one vote per share. Shareholders have the right to vote in elections for the board of directors and on proposed operational alterations, such as shift of corporate aims and goals or fundamental structural changes. Shareholders cast votes at a company's annual meeting. If they cannot attend, they may utilize a proxy vote to convey their wishes. The primary market is the one in which new securities are sold to investors for the first time to raise capital for the issuer. An initial public offering (IPO) is an example of a primary market. The primary market is where a company offers securities to the general public to raise funds to finance its long-term goals. The secondary market can be viewed as a pre-owned securities market, where investors buy and sell existing shares. On large stock exchanges, billions of shares may be traded between buyers and sellers on a single day, and these are all secondary market transactions. Money flows from the investors buying stocks to the investors selling them, and the company whose stock is being traded is largely unaffected by the transactions. To sum up, the primary market is where securities are created, while the secondary market is where those securities are traded by investors. In an auction market, the exchange-designated market makers match up the orders of thousands of investors. Most major exchanges around the world, such as the New York Stock Exchange, Tokyo Stock Exchange, the London Stock Exchange, and the Deutsche Börse are auction markets. But the auctionee in these cases is a computer. This means that there is no stock exchange floor to show on the evening news, and no one needs to ring a bell to start a trading. Trading on the stock exchange takes place in the form of bids and offers by exchange members, who are acting as agents for institutions or individual investors. Buy and sell orders meet directly on the trading floor, and prices are determined by the interplay of supply and demand. A dealer market is a negotiated market in which investors deal directly with dealers. Dealers specialize in various assets, purchase these assets for their own accounts, and later sell them for a profit from their inventory. Dealers profit from the spreads between the bid price and the ask price. For example, Nasdaq is a dealer market. All trades on Nasdaq take place between investors and professional dealers who are prepared to buy and sell stock. Lastly, before I end this presentation, I have some homework for you. Do look out for the definition and meaning of the following terms. This slide has provided you with a short description about how the value is calculated. With good understanding about all these terms, you can master the knowledge about equity valuation better. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you. See you and goodbye.